Good morning, everybody. I'm Patrick Beitel, a partner at McKinsey and Company, and I do serve stock exchanges, CCPs, settlement organizations, as well as wholesale banks for about 15 years. Thank you very much for inviting me again to this illustrious group here in Istanbul. I've got the pleasure to open this morning with a short keynote on growth. Growth in an environment which has become more and more challenging. And I'm sure you're thinking all hard about the growth question, which has become more and more difficult over the last years. So thank you very much for giving the question to me. I'm pretty sure that I can provide you with some perspectives on growth, where growth should come from. I will definitely not have the silver bullet for you, as growth will be different for each of your organizations. But I hope that some of those perspectives will help. So let me start a little bit reflecting upon the market environment that exchanges are operating in at the moment. So the market environment itself has become more and more difficult. If we look into equity trading volumes have not grown a lot. The volumes have been almost flat in the last 3 years. And we are globally around $20 billion below 2007/08 equity trading volumes. And if we calculate the growth of equity trading volumes in the last 5 years, we have seen some 2 to 3% growth. Also, volatility was not that bad, but could not contribute to significantly boost equity trading volumes since 2009. So it has not been that easy to be an equity exchange as a regulated market. Brian has mentioned it, the MTFs have gained quite significant market share. In Europe, they enjoy around 25%, in the US around 29%. And only if you look into derivatives exchanges, the picture is different. Yeah? The number of contracts traded have more than doubled over the last 5 years, with Asia contributing most to that growth. So secondly, the financial crisis led to regulators taking decisive action to prevent future crises. Yeah, you all know this, MiFID II, CRD4, Basel III, EMIR, Dodd-Frank, and the recent debate of the financial transaction tax takes away the breath in the industry. And regulators also have become a much better understanding of the market infrastructure space, and it will become more and more difficult to shape regulators' perspectives in a way that it's neutral to your profitability and to your margins. I think the assessment of the European Commission with regard to the financial transaction tax shows this impressively. If you look into what the European Commission has put forward, then they assume that a huge portion of cash equities trading will simply relocate or stop in the case of a financial transaction tax being introduced. And they even say and state in their own impact assessment that up to 90% of derivatives trading volume will simply vanish if a financial transaction tax is being introduced. So going forward, regulators that have been focused in the past years very much on market stability and integrity, in my perspective, will come back to a theme that there was before the financial crisis, i.e. stimulating competition between capital market infrastructure providers, which means to create a level playing field between regulated markets and MTFs, between CCPs and between CSDs. And this means interoperability and access across the value chain. Also, regulators have taken a much more prudent stance on consolidation lately, and keeping control of local market infrastructures has been considered much more important than creating further scale. In some cases, because the regulators did not believe that the scale advantages would be really delivered to the customers. And so we've seen Singapore and Australia fail. We've seen London and Toronto fail, and we've seen New York and Frankfurt fail. Thirdly, your customers are pretty much under pressure as well. Yeah? Increasing cost of capital, increasing cost of funding, and additional collateral requirements make it very difficult for your customers to stay profitable and to keep in business. As you can see on my first chart, business returns for your clients measured by ROE have been around 20% pre-crisis as an average across all different product markets in capital market products. We estimate that this return will go down to about 7% on average in an unmanaged outcome. And even after mitigating action, profitability levels will get back only to a level of around 12 to 14% ROE on average for the industry. Findings from our global capital market surveys that we do with your customers demonstrate this also very impressively. Yeah? For all flow products, volume grew much faster than revenues. For most in FX and equity derivatives, but also in cash equities, we have seen growing volumes at shrinking revenues. This will put a lot of pressure on your customers to reduce costs in order to stay profitable, and they can either do it by increasing scale themselves, aggregating more volume, or by putting pressure on transaction costs, and I think this is where it will hit you again. And it's not so that you have not been under pressure to bring down prices with the MTF competition being around. So fourthly, I think differentiating technology will be a key differentiator going forward again. Technology was key in the mid and early 90s when you started to electronify your markets. After that, technology has been rather considered being a commodity. Now, with your customers becoming more and more sophisticated, trading at higher and higher speed using more sophisticated algorithms, low latency technology and everything that goes around that is a big differentiator again going forward. And finally, governments in the developed world and in particular in Europe, and banks also in particular in Europe, will start to deleverage significantly over the coming years, and this will cost economic growth and most probably GDP. We actually do a survey with around 2,000 executives globally on global economic scenarios, and this comes out sort of with a scenario that we call the decade of the dragon and the tiger. The scenario, which you see on the right bottom hand here, has a probability of around 45%, which is almost twice as likely as a scenario in which we get into balance soon again. In this most likely scenario, the developed world slows down because of a failure to rebalance debt and deficits, while emerging markets sustain robust growth rates. Key growth drivers for cash and derivatives exchanges will be affected through a potential economic downturn. If you think about the number of listings, they will not for sure picking up in markets where GDP growth is sluggish. Trading will become less attractive with additional capital requirements, and we will also most probably see low interest rate environments in order to stimulate growth, of course. But this will not create a lot of fantasy for hedging interest rates. So coming years, I think, will be quite challenging. Yeah, the volume outlooks are rather moderate positive. The regulators will be on your backs, and your customers will significantly increase the pressure on you. So congratulations. Yeah. Let's talk about some options to address these challenges. We recently did some very long-term analysis around growth, and some of you might know our granularity of growth work. In this analysis, we have decomposed the origins of growth for the top 400 global companies in an 8-year period. The analysis shows that having a sound growth strategy is pivotal. In the 8-year period that we've analyzed, the top 400 companies grew with about 10% per year. Around 65% of the growth came from portfolio momentum, which is market growth. This means the growth of the markets that you are invested in. So picking the right markets to play in is really key. In addition, you can grow by mergers and acquisitions. Growing through M&A is, as you can see, significantly less relevant total growth than portfolio momentum, and contributes to around 1/3 to overall growth. And finally, and this is an amazing and a sad result, market share gain contributes only to around 0.4 or 4% of overall growth. And this is sad because a lot of top management teams spend a lot of time beating their competitors, and the result of that is quite minuscule. So what does it tell you? It tells you you have to be invested in growing markets, being growing geographies or being product markets, and having the right growth strategy that gets you there really matters. So where is growth coming from? Growth is coming from Asia and emerging markets in terms of regions, and from derivatives in terms of products. In particular, in the last 5 years, the markets in Asia Pacific have grown much, much faster than the developed markets. Asia Pacific grew with about 9% per year in cash equities, and in derivatives, as you can see, in terms of number of contracts traded, Asia has already overtaken North America, growing with around 23% per year as opposed to 12% in North America. If you allow me to break this down into some product markets, you can see that derivatives such as equity index derivatives or single equity derivatives outgrew cash products, and again that the emerging markets outgrew the developed world. The differences are enormous if you, for example, take the 56% annual growth in equity index derivatives in the last 5 years in Latin America and compare it to the 4% growth in cash equities in Europe. So no wonder that most of you have started to explore partnerships with exchanges in Asia and the emerging markets, and examples include, for example, the NYSE with Tokyo or Nasdaq OMX with RTS or SGX. So addressing the right regions as well as the right products is absolutely key. Cracking Asia will be an important driver for growth. Also, it will take a lot of time as local regulators are still very protective in those markets. And diversifying the product base into derivatives or into commodities is another important growth driver, which will help you to grow and which help you to further leverage your infrastructure efficiently. One other question that I'm supposed to tackle is around cost. So what does it bring you to bring down cost in such an environment? Bringing down cost, first of all, is a defensive move. It may only help you to sustain volumes and profitability levels. Gaining volume and being a volume leader by being the most cost-efficient player is typically not a bad strategy. Yeah, that strategy works pretty well in industries where commoditization and standardization is key. Take, for example, industrial norm items with ISO codes that precisely describe quality. Yeah? There, being a cost leader really is an advantage because quality is measurable and there's only one quality that everybody adheres to. And of course, if you think on whether this strategy has worked also in your industry, then you can say for the most liquid stocks, MTFs were playing exactly that strategy, but it might not work out if you want to be the market for SMEs and for primary as well. Most of you have been focusing on cost and cost reductions in the past quite significantly, and a lot of you have been quite good at it. Yeah? The chart that you see here describes the cost development over the last 4 years for a number of exchange groups, and you can see that almost all players kept their relative costs, which is total operating costs per FTE, very, very stable over the last years, and also a number of players have significantly brought down costs. But bringing down costs will not bring back the volumes that you might have lost to MTFs. It will only help you to sustain market shares and to manage your profitability. So how about pricing? Yeah, will sophisticated pricing strategies help you to grow? Of course, pricing can help. Innovative pricing may help you to keep large customers and possibly to attract new ones. If you take, for example, the telecoms industry, their pricing has been really key to maintain customers and fighting for market share. Think about the flat rates that they've introduced, and think about how they could transfer to your industries. If customers, for example, pay a flat fee to trade on your trading platform, they might not actively seek for alternatives because the incremental cost that they have for loading your platform goes down for them, and that might create a win-win situation for you and for your customers. But again, pricing strategies typically do not significantly contribute to growth, and they might even reduce profitability. And when we look into your industry, then pricing schemes are already very sophisticated, or at least very complex. Average prices across equity exchanges over the last 5 years have been slashed in almost all markets. Since 2007, BMF Bovespa of Brazil, BME, or the SIX, for example, have reduced effective prices. And this is simply trading revenues divided by trading volume by more than 50%, and Deutsche Börse and Nasdaq reduced prices by around 30%. And getting back to higher prices, given the competitive pressure that you have from MTFs, will be really, really difficult. And only if you can add some elements to your services, value-added services, you might have the opportunity to price up. So there is for sure some potential in pricing, but it will not be a silver bullet, and bringing your business back onto a strong growth path through pricing will also not work as a single lever. So you may ask the question around consolidation, on whether consolidation will be the only way to create sufficient scale in order to have the efficiency advantages that you require to maintain volumes and profitability. And as I mentioned, regulators have taken a quite negative stance on consolidation in the last year. If we consider consolidation from a pure economic and shareholder value-driven perspective, there might not be many deals that are possible in terms of size and in terms of price-earnings ratios, not diluting valuation multiples. The combinations that fit it in terms of size and in terms of PEs, such as London and Toronto, Australia and Singapore, Frankfurt and New York, failed. And those who are left are scarce, and we might not see very sizable transformational transactions in the future. But of course, M&A will be a driver of growth, and we have seen exchanges like the ICE or the CME being built majorly by M&A. But I think going forward, we will see rather smaller stuff than bigger stuff. Then regulation is not just a threat, but an opportunity as well. And there is certainly an opportunity around capturing OTC trading and clearing. And many of you do have initiatives running to capture these opportunities. And of course, they are big as well. In the latest estimate, Morgan Stanley put forward a number for the market for OTC clearing, and it estimated the market at around 1 billion euros in additional revenues for the industry, and the opportunity to capture OTC trading flow might be of similar size. So what's missing? Innovation. Financial innovation has been a driver of growth, and maybe the most significant one. Innovation in products, functionalities, and services offered will be key going forward as well. Let me give you some examples. The rise of derivatives since the early 90s has been strongly driven by innovation. ETFs as passive or active investment instruments for equities or bonds, or like recently being introduced for commodities, are another great example for innovation. Retail certificates have been one that a number of smaller exchanges were able to benefit from. Contracts for difference may be the next one. A number of online brokers have already identified this opportunity for retail customers and offer them a huge bunch of trading products. And innovations were not only related to trading products, but were also related to technology, low latency connectivity, and even we've seen innovations around hardware, like offering faster chipsets for high-frequency traders or adjacent services around low latency like data. And the use of algorithms for trading has been an innovation. A recent analysis from IT Group projects the use of algo trading as a percentage of total trading to be in the area of 65% for equities and around 50% for futures. And even for fixed income, they recognized a steep pickup recently. A lot of innovation is happening in the OTC space, as innovation often does not fit standard patterns and products being traded on regulated markets. And exchanges in the past have not been fast enough in order to innovate. And here I think the key opportunity is for you. You have, I think, to become more innovative by sort of changing your technology processes, your product development capabilities, to increase innovativeness and to stimulate growth. So if I conclude, then the market environment, as I mentioned, will be very difficult in the coming years. Also, the competitive landscape will not be easy. I think that there are no easy answers for growth for your business. Many levers will contribute to growth, and I think you will have to pull most of them at the same time in order to generate a decent growth. And most importantly for this will be emerging markets, will be Asia, will be derivatives, and will be product innovations and also technological innovation. So with these thoughts, let me hand back to Brian, and thank you for your attention.
Are there any questions, ladies and gentlemen? If I can kick off, maybe how much volume do you think is at risk for the incumbent exchanges based on the regulatory changes that are coming up with Basel 2.5, 3, MiFID 2, etc.? Do you think they're going to lose more volume or will they gain more volume?
I think from the impact analysis that I've seen, the volume impact of regulation can be quite significant. As I just mentioned, with the financial transaction tax, volumes will be significantly hurt. A lot of the high-frequency trading, for example, is expected simply to stop or to go to other markets. And also for the other regulations, sort of where significant competition is being forced into the markets, we will see volume shifts. The MTFs are preparing to enter the derivative space, and as a consequence, I'm pretty sure that a lot of volumes are at risk to move over to either new players in the industry or are being addressed in a way that they relocate to different regions or to less regulated markets or stop being there. So the threat is real, and it can be really, really big. It can be in the magnitude of significantly above 30%.
Okay, if the financial transaction tax doesn't happen, but some of the others do, then maybe it's not so bad. Are there any other questions? Yeah. John White from SIX, and then there's one to the left.
Thank you, Brian. John White from the SIX Group. Just interested in a point that someone touched on yesterday, which is the demographic time bomb and governments being less able over the long term to fund pensions for an aging population. What impact do you think that might have on the exchange space? In particular, how do you see the balance between sort of institutional flows and retail flows playing out over the long term?
I think it's a very good question, that you ask, and of course demographic shifts and an increasing sort of pension gap in the developed world puts a lot of pressure in a way on the markets. I think what's quite interesting is that if you look into emerging markets, that, for example, the markets are very much more dominated by retail flows as of today, and that the institutional portion in these markets is, compared to what we see in the developed world, still very, very, very small. And when you think about sort of capturing flow in these markets, it's more about retail. On the other hand, the institutional flow in these markets by sort of upstepping pension schemes or introducing pension schemes into these markets will be sort of a huge opportunity for growth in these markets. So I'm pretty sure that we will see a steep uplift of institutional flows coming from Asia that need to be invested somewhere. And of course, they can invest into Asia. They will invest into Asia, but they will also seek for diversification, and they will seek to go and to invest into the developed world, into Europe, into North America, into Africa, Latin, wheresoever. And this will also stimulate growth to some extent sort of for your markets in Europe. Yeah, so on the one hand, there might be pressure in Europe for the flows. On the other hand, there is a huge opportunity from emerging markets, where in particular institutional flows will increase because sort of in these markets there need to be pension schemes as well, and there need to be some sort of protection for the retail investors, and the retail investors there are significant in terms of size, yeah. And if this is being channeled into institutional flow, this is huge, but it will take some time, yeah. It might take some 10, some 15 years in order to get to a significant level.
There's a question.
Thank you, Patrick. My name is Ibrahim Laradi from Bahrain Bourse. Actually, I do agree with the importance of growing the business of the exchanges, but I believe that what it looks that the main purpose of establishing the exchange is serving the national economy and helping the people investing their saving. But it looks like the war has been changed, and most of the exchanges are looking just to grow their business and imposing more fees and collecting more money. If we look to the recent crisis, either in late 90s, the high-tech bubble crisis, in 2008, the international crisis, and recently the European crisis, most of the reason, if it is not the main reason, is the greed of the people to collect more money. I think the main reason we have to think as an exchange to serve the national economy rather than just collecting money and imposing more fees on the people. Otherwise, we can close the exchanges and turn it into a casino. We can get more money and much easier.
Mm-hmm. I guess the point is that exchanges have, now that they've demutualized and listed, are no longer agents of economic development for a country. They're just regular companies. But I don't know what your view is, Patrick.
Yeah, I think you mentioned a very good point, yeah, and I mean this whole development just started 10 years back, yeah. Before that, exchanges were owned by the market participants, and the market participants had a strong influence on the market infrastructures in a way. On the other hand, exchanges have still sort of maintained their position of being neutral providers of market infrastructure, yeah. And of course, you can argue on whether the margins that even at the market infrastructure level are being generated are too high. Nevertheless, you need some margins, you need some profit orientation in order to create some innovation at the market infrastructure level as well. And I think what we've seen impressively also in the financial crisis is that market infrastructures have proven to be very, very resilient, yeah, and have contributed significantly to market integrity. If we think about the blow up of Lehman or MF Global in the derivative space, then the CCPs have created significant stability, and the risk systems stood firm. Yeah, the margin calls that have been collected were sufficient in order to close all positions of both Lehman and MF Global within some days. Yeah? Asset segregation is a key innovation that helps to stabilize the markets going forward as well. And I think as exchanges, you have more to focus on this element of creating integrity and of creating safety in markets, and in a way make sure that regulators and that also your customers understand that this is a very important function that you fulfill in a market, and that such a function needs to be there and needs to have further investments, etc. Yeah? So I think there is not forcefully a contradiction between a for-profit orientation of an exchange and an exchange being prudent and making sure that a market works and functions in a stable and integer way. I don't know if this answers your question.
One last question, then we'll do the next panel.
Yeah, it's Olof Neilik from Burgundy. I had some doubts on your analysis of exchange revenues, because it looked from your analysis that the revenue came down 30%, but I think for some of the smaller exchanges it's quite the opposite. I have customers who pay more per million traded today than 3 years ago, because transaction fees came down, but technology fees, market data fees, all types of fees have been added to the total spend by banks. So have you done any analysis on the total cost of trading on an exchange, including all the new items that were not there 3 years ago? Because I have a different view on this. I think actually some exchanges have been able to increase their margins.
Yeah, my chart was not on volumes. My chart that I had was on prices. So, which was simply a very, very simple analysis because analyzing pricing structures is quite difficult. And what I just did is I took the overall revenues and divided it by the total trading volume, yeah, for the different segments in these exchanges. And here you can see that the effective prices, in a way, yeah, so the revenue per unit have gone down, yeah. Overall, if you look into volume development for the industry in cash equities, it has seen some 2 to 3% growth as an industry. So the huge reduction of prices did not lead sort of in a huge uptake, at least for the industry in terms of volumes. Yeah, and we've seen volume shifts towards the MTFs, etc. And if you think about the fact that most of the incumbent exchanges have had stable revenues over the last years, and that at the same time the MTFs grew to a market share of around 20 to 25%, then you might come out with the conclusion that the overall market size has been growing. It just has been redistributed to a way. On the other hand, you might ask yourself the question whether there is a lot of elasticity in trading volume, and on whether bringing prices down even further might increase sort of the likelihood of getting further volumes on your platforms. And there, I think there might be some limitations, yeah, given that sort of in the end, your customers somehow control where the trading flow goes, and they have decided that they wanted to move a huge part also on MTFs to put pressure on you to bring down prices in a way. I think they are satisfied with the platforms that you've got, but maybe not with the price levels that you sustained, and they wanted to bring them down, and they used the MTFs for that purpose. I think the key question for me will be on whether MTFs going forward can sustain their model. Yeah, if you think about bets sort of having introduced to go into primary as well, they have gotten an exchange license in the US. They've taken over kayaks here in Europe. Let's see on whether they will be able to sustain the model. Yeah, Bats has announced an IPO for this year. If they IPO, they might change their shareholder structure as well. And this change in shareholder structure will bring them into the very same problem that you are in, sort of that the users of your platforms are no longer your owners. And this might, again, create opportunities to take away some revenues, again, from the MTFs.
Okay, thank you very much, Patrick.